Tom Lee, head of U.S. equity strategy at JPMorgan Chase, forecasts the S&P 500 will end next year at 1,300, which is up almost 18% from yesterday's close. Tom joins us now from New York. Tom, let me ask you first about the economic data that we saw today and what we've seen coming in recently. Does this continue to feed into your better than street consensus forecast for the economy?
It does, Matt. I mean, it's positive on two fronts. You know, on the retail sales number, I think it's really showing you our thesis about pent-up demand really taking place. You know, we have high unemployment still, and retail sales have been up for 4 months. And in fact, for the month of November, you know, the first 3 weeks were very weak, and so we saw the Black Friday really take off. So I think that's very encouraging. And then from the inventory side, you know, it's the broadening of business activity that you're seeing with the inventory builds.
Let's talk about the retail number first. I mean, does that say to you, that number, that consumers are waiting to do their holiday shopping until the very last minute? I mean, aren't they waiting for deals that will cut into profits at retailers?
Well, you know, I think that there's probably a realization from consumers now that last year's conditions don't exist in retail. You know, retailers don't have the inventory, so they're not discounting as steeply. But without question, the American consumer historically has always responded to discounts. So discounting is important, and I think what you're really seeing, though, is the pickup from November, and I think it's really continued in the month of December as well.
All right, let's talk about your stock market outlook. 1,300 by the end of next year. Aren't you concerned that at some point the Fed comes in and removes some of the liquidity that it's put out into the system, even if it doesn't start to raise rates until the end of next year?
Yeah, I think it's going to just depend on how the market interprets that, but it does make a lot of sense that a lot of the liquidity programs start to kind of run their course, so they get withdrawn, but we can't really predict the future on that. There's a little bit of room for rates to rise and it not to hurt stocks, simply because credit spreads are still going through compression. And I think equity investors really take their cues from what's happening in high grade and high yield.
You're basically expecting, though, not a V-shaped recovery here, right? You're expecting a U-shaped recovery, and you're hoping, along with a lot of other investors that are bullish long in this market, that the Fed will remain accommodative because of that. What do you base that on?
Well, you know, historically, it is Goldilocks for investors to see low rates and kind of a weakish recovery, because that lets them find growth stocks, you know, stocks that are going to outgrow the economy and they're going to outperform. And I think that scenario makes a lot of sense. You know, the base case for JPMorgan's economic forecast is unemployment to only fall by 50 basis points. So it's not a job-full recovery. But what I would caution is, I think when you look at how retail sales are improving, how inventories are broadening, and how claims have improved, you know, it's pointing to a much more vigorous recovery, and I think that's not discounted in stocks.
I wonder, though, don't you think that cyclicals have already had their run? I see you're still overweight cyclicals, whereas a lot of other investors are shifting so much into the big names, big quality names here.
Yeah. Well, you know, I think cyclicals are going to really run their course when we've embraced the broad recognition that a recovery is underway, and you'll see it when the ISM hits 57. Also, when people start to worry about inflation and when earnings revisions runs their course. But, you know, as you know, earnings are still moving up. Actually, in the first quarter, it's going to be the first quarter we're going to have high single-digit year-over-year revenue growth for the S&P. So, I mean, there's a lot of things that are to favor cyclicals in the first quarter, in the first half, really.
All right, so what do you pick as far as sectors here? I mean, because of your positive, optimistic outlook on the holiday shopping season, are you into retailers?
Well, you know, retailers have had a big move, so in some ways it makes a lot of sense to own retail, but you have to be very careful because, you know, it's really about same-store sales and inventories. So we think it's going to make a lot of sense to play really the strengthening consumer through financials, because a byproduct of that is strengthening consumer trends, which is helpful for banks. And it's also going to be the industrials, because industrials are going to really respond to higher consumer confidence. You're going to see more companies talk about expansion, and I think what M&A is going to be a pretty big story next year. And I think you're going to see a lot of that in M&A in financials and industrials.
All right, Tom, thanks so much for joining us. Tom Lee coming to us there from JPMorgan.